Hello, this video is about volatility in finance, what it means and how it applies to stocks. Understanding volatility. Volatility refers to the degree of variation in the returns of a security or market index. It is a statistical measure commonly calculated using either standard deviation or variance. Generally, greater volatility signals higher risk as prices can experience sharp increases or drops quickly. Volatility typically reflects significant price fluctuations in financial markets. For example, the market is volatile when stock price swing more than 1% in either direction over an extended period. This characteristic is essential in pricing options contracts. What is volatility in the stock market? Volatility is the incidence and consequence of price actions in the stock market. The more knowing and frequent the price shifts, the more volatile the market is. Reviewing current volatility in the market. The CBOE Volatility Index uncovers market instability. It determines shareholder risk by calculating the indirect volatility in the estimates of a basket of put and call choices on the S&P 500 index. A high VIX reading more marks areas of higher stock market volatility, while low interpretations mark periods of minimal volatility. The S&P 500 drops when the VIX rises, which naturally signals a good time to buy stocks. What volatility tells us? At its core, volatility highlights the uncertainty of or potential risk in a securities price movement. High volatility means prices may vary quickly, while low volatility indicates more stable prices. Volatility can be measured in various ways, with one standard method involving the analysis of an asset's daily return percentages. Based on past price data, historical volatility represents how much an asset's returns have varied. Usually shows as a percentage. This measure doesn't have a unit and can be calculated for different periods, daily, weekly, monthly, or annually. The common method is to view it as an annualized standard deviation. Calculating volatility. To calculate volatility, you use standard deviation, which itself is derived from variance. Here is a basic formula. Volatility equals sigma square t. Sigma is the standard deviation of returns. T is the number of periods considered. Example, calculating volatility from stock prices. Suppose you have monthly closing stock price ranging from $1 to $10. Here is how to determine the variance and the standard deviation. Find the mean average. Add all prices and divide by number of values. 1 plus 2 and more plus 10 equals 55 divided by 10, $5.50. Calculate deviations from the mean. Subtract the mean from each value. Example, $10 to $5.50 equals 450. 9 minus 550 equals 350, etc. Square each deviation. This removes the negative signs and emphasizes larger deviations. Sum the squared deviations. The total in this example is 82.5. Find the variance. Divide the sum by a number of values. 82.5 divided by 10 is equals $8.25. Calculate standard deviation. Take the square root of the variance. That is square root 8.25 is 2.87. The standard deviation reflects how far prices are on average from the mean. It gives investors a sense of potential risk or unpredictability in price movements. I hope you like this video. Thank you very much for watching it. Please do not forget to subscribe to my channel. Thank you. Bye for now.